All right, let's dive right into this explainer and really unpack Meta's absolutely stunning 2025 financial run. And of course, their staggeringly ambitious future. If you've been watching the tech space lately, Meta's story has been a complete roller coaster. Today, we're breaking down their official Q4 and full year earnings presentation, crossing it with some independent analysis, and figuring out exactly how Meta is funding what might literally be the largest technological gamble in corporate history.
Before we even get into the billions of dollars, we really need to talk about billions of people, specifically 3.58 billion. That's how many daily active people were logging into a Meta app every single day as of December 2025. I mean, just pause and wrap your head around that scale for a second. We are talking about nearly half of the global population checking Facebook, Instagram, WhatsApp, or Messenger every single day. Meta calls this metric family daily active people, and it actually grew by 7% year over year. This right here is the absolute bedrock of everything we're about to discuss. Without this unprecedented captive audience, none of Meta's future ambitions would even be mathematically possible. To make sense of this massive earnings report, here is our quick roadmap. First, we'll look at Meta's 2025 scorecard. Then we'll address the Q3 tax anomaly, compare apps versus reality labs, dig into the superintelligence gamble, and finally look at the investor verdict. Let's get to it.
Okay, starting off with Section 1, Meta's 2025 scorecard, a record year. The sheer scale of this 2025 scorecard is frankly wild. Pulling in over $200 billion in total revenue for the year, and doing that while keeping a massive 41% operating margin, that means they are keeping 41 cents of pure profit for every dollar earned, which is just a rare, rare feat in any industry. To grow revenue by 22% year over year, when you are already at this mammoth size, shows incredible momentum. And plus, look at that free cash flow of $43.59 billion. That's cold hard cash left over after paying to run the entire business, giving them an unparalleled war chest to invest, acquire, or return capital to shareholders.
Moving on to Section 2, the Q3 tax anomaly, which is definitely the elephant in the room.
Now, if you just glance at the raw numbers, you'll see what looks like a total cratering of net income down to just $2.7 billion in Q3, which is then immediately followed by this towering, massive rebound to an all-time high of $22.7 billion in Q4. Honestly, if you were just reacting to the headlines during Q3, you probably would have hit the panic button. But, as always, the real context is right there in the fine print of the earnings release. So, that massive dip, it wasn't a business failure or users leaving or a collapse in ad pricing, nothing like that. It was actually a huge $15.93 billion non-cash tax charge. This was all tied to the implementation of the One Big Beautiful Bill Act. It's a one-time legislative event that basically drove their effective tax rate for that specific quarter to a staggering 87%. Crazy, right? Once you understand that, the whole narrative shifts entirely. Meta didn't stumble at all. They literally just absorbed a gigantic one-time accounting hit.
You can actually see this exact same story play out when you look at earnings per share, the profit allocated to each individual share of stock. It dropped down to $1.05 in Q3, but Meta's filings clarify that if we just exclude that quirky tax anomaly, Q3 would have actually been a really robust $7.25. So the underlying business was just humming along flawlessly the entire time, perfectly paving the way for the stellar $8.88 per share they actually delivered in the Q4 holiday quarter.
All right, let's jump right into Section 3, Apps versus Reality Labs, the engine and the burn.
This comparison is absolutely fascinating. It shows how the incredibly profitable family of apps basically acts as this giant money printing engine, and that engine directly funds the massive cash burn over at the Reality Labs division. Just look at Q4. The family of apps, so your Facebooks, your Instagrams, generated over $30.7 billion in operating income. Meanwhile, Reality Labs, which is focused on virtual and augmented reality hardware and software, lost $6 billion in that exact same 90-day window. It is a wild dynamic. You've got one side of the building optimizing ads for billions of users, while the other side is just burning billions trying to indent the next computing platform.
So the really crucial takeaway here is that Meta's core advertising machine isn't just surviving right now, it's actively accelerating. Q4 ad revenue grew 24% to a whopping $58.1 billion. And what's driving all of this? Based on independent analysis from SureDividend, it's not actually just more users logging on. It's coming from huge performance gains from their AI-powered ad targeting and recommendation tools. They're basically squeezing more value out of every single ad impression, which ensures they have that immense cash flow required to fund Mark Zuckerberg's ultimate vision.
Which brings us to Section 4, the Super Intelligence Gamble, 2026 and beyond. With this one single sentence from the Q4 earnings release, Meta is boldly planting its flag in the race for advanced AI. Quote, I'm looking forward to advancing personal superintelligence for people around the world in 2026. Think about that phrasing. Mark Zuckerberg isn't just talking about chatbots or slightly better algorithms anymore. He is specifically using the phrase personal superintelligence. It's a massive signal to the market, to competitors, and to top-tier talent that Meta fully intends to be at the absolute frontier of artificial intelligence development. But as you might guess, reaching that frontier requires capital on a scale we've rarely seen. In fact, that single sentence carries a staggering cost: $115 to $135 billion in guided capital expenditures just for 2026. Just take a second to absorb that number. That is not general operating expense, okay? That is money earmarked purely for physical and digital infrastructure. They are planning to spend well over $100 billion just on the hard assets required to make superintelligence an actual reality. So, where exactly is all that cash going? Well, Meta's CFO outlook explicitly states this spend is shifting aggressively into heavy AI infrastructure. We're talking about building out their new Meta Super Intelligence Labs, massive third party cloud expenditures, constructing brand new data centers, and of course, engaging in an incredibly expensive war for top tier AI technical talent. They are literally laying the physical foundation for the future of computing, and they are clearly willing to pay whatever it takes to own it. And finally, Section 5, the investor.
Hello, so let's analyze Meta stock. So all of this information that's provided here, it uses my own custom LLM model that basically takes in all the information and generates a business summary, bull, bear cases, and provides you a lot more information. So if someone's interested, they can pause to read through it. All right, so let's look at their key metrics. So some of the key metrics as shown here. So 3 of them metrics are not passing while the other 6 are. So obviously because, they are spending a lot of their free cash flow in capital expenditure. So I can understand why these metrics are not passing. And then these are some of the key financial metrics and profitability and quality of the business. So obviously, like if the metrics are not passing, doesn't always mean that business is not worth investing, but we'll look into it further. So some of the financial statements. Let's look at revenue. So as we can see in the last 5 years, they've been on an uptrend. This is annually. Yep, this is annually, and they're doing tremendously well, incredibly well. And then this is their R&D, and as you can see, this has also been on a uptrend as well in the last 5 years. They've been spending heavily on R&D as well. And then let's look at their shares dilution. But we can see that they've been buying back their shares, which is good for shareholders as well. So you get more value for their shares. And gross profit, it's also been on an uptrend quite a bit. And let's look at their free cash flow. As we can see that this is kind of like, been kind of up and down because they've been spending a lot of their R&D as we've seen. So that makes sense, I guess, but still they do hold quite a bit of free cash flow as well. In the recent quarter, they currently hold 46 billion. So let's look at the valuation. So all right. So this is assumptions. These assumptions are generated via my own custom LLM model that uses economic data, company's business model, its future potential. It uses a lot of information, and then to kind of come up with these assumptions, and then based on that assumptions provide the rationality behind those assumptions as well. So for example, if And these are some of the other sources like it gathered all the information from as well. So if you believe in these assumptions, then we can definitely like, apply these assumptions. And as for the PE ratio, as for its PE comparable ratio for multiples model value, if anyone interested, I'm gonna go with 18, 23, and a 28 because it's a dominant tech monopoly, basically company that's growing double digit and does not trade to, I believe, in lower multiples. So the tool is so the tool that I use, like, they like the for the PE, I kind of like leave it for my own assumption. So I kind of like adjusted it based on what I believe it should actually worth. And then also for the rest of them, like for the actual valuations, like if you believed in these assumptions and the rationality behind these assumptions, as you can read through them, let's update the valuation model and let's see. So if you believe on the assumptions that it was generated via the AI model, then the bear case to be 500, the bull to be 1196, and the base to be 825. There's an upside potential of 30%. But thank you for watching. And like I said, if you believe in them, I would recommend doing your own due diligence even further. And see you in the next video.